Capital Budgeting Principles. This is the second video in our series. At the end of the first video, we listed some techniques that are useful in evaluating projects. The first two techniques were the net present value, NPV, and internal rate of return, IRR techniques. In this video, we take a closer look at those two techniques. The net present value, or simply NPV, of a project is the sum of the present values of the expected future net cash flows from the project. And here is our equation. The CF stand for the net cash flows. There's a net cash flow at time zero, and that's going to be your initial investment. You expect that to be a negative cash flow, a net cash outflow. And then CF1 is your net cash flow in year one, and so forth. R is the project cost of capital. It's the required rate of return, the risk-adjusted required rate of return for that project, and is the discount rate for the future net cash flows that have been estimated. Let's give some insight into this. Of course, CF at zero, as we've said, would be a negative cash flow, a net cash outflow, your initial investment. Let's now look at the remaining terms. You have the first term here, CF1 over 1 plus R. That's the present value at time zero of the net cash flow you expect to receive in year one. The next term is the net cash flow in year two, discounted back 2 years. That's the present value of time zero of the net cash flow in year two, and so forth through all the terms that you have. So you're converting each of these future net cash flows into a present value, and you're summing them. When you add these together then, these time zero values, you're getting what the project is worth to you. It's the value of the project at time zero, but we want a net present value, so we compare the value of that project with what it costs to undertake the project. And if the value of the project exceeds what it costs to undertake that project, it will have a positive net present value. And if that's an independent project, we'll see that would be a project that should be accepted. Let's look then at the decision rule or decision criteria using the NPV. Again, if you have an independent project, you would accept that project if its NPV is greater than zero. If you have mutually exclusive projects, now you have alternative projects. You have 3 projects, A, B, and C. You just want to choose one of them. You would select the project with the highest net present value. Let's move on to the internal rate of return. Once we've covered both techniques, we'll do an example. Now, let's go back to NPV just for a second and set the stage. With NPV, we have to estimate the project cost of capital, and that's an input into the calculation. And then we get the left-hand side here and see whether it's positive or negative. Positive being acceptable project, negative being unacceptable project. What the IRR does is it sets the NPV equal to zero. It's going to use the same formula, but set the NPV equal to zero, and we're going to solve for R. We're going to solve for that discount rate. And that value for R that we arrive at is the internal rate of return. So you'll notice then we use the same formula, but we set the NPV equal to zero and solve for the unknown interest rate, IRR. Of course, you should recall that that's going to be an iterative or trial and error solution. It would be impossible to solve for R using basic algebra explicitly. So we'll rely on Financial Calculator or Microsoft Excel when we're going to calculate these. What are the decision rules or criteria for IRR? Well, for an independent project, you would accept the project if the IRR exceeds the cost of capital for the project. Okay? The cost of capital, think of that as a hurdle rate, the screening rate for the project. The IRR has to clear that hurdle. It has to be higher. You need to expect to earn a rate of return on the project, the IRR, that exceeds the required rate of return for the project. Okay? Now, if you have mutually exclusive projects, we get a little bit of a surprise here. We would, I think, initially think intuitively that you'd want the project with the highest IRR, but that's not always the case. Using IRR to rank mutually exclusive projects may lead to accepting the wrong projects. There are times when you have mutually exclusive projects that the project with the highest NPV will not be the project with the highest IRR. We're actually going to illustrate that case. So my suggestion to you with mutually exclusive projects, use the NPV technique and select the project with the highest NPV. Okay, let's move to an example. Consider 2 projects, Project S and Project L, which have net cash flows shown below. Both projects have a 10% cost of capital. Compute the NPV and IRR for both projects, and we'll decide whether to accept or reject the projects. Okay, you can see they both are 4-year projects. Project S has a net cash outflow at time 0 of $10,000, followed by inflows, as you see, $5,000, $4,000, $3,000, $1,000. Project L has a slightly smaller net cash outflow, $9,550, and then net cash inflows of $1,300, $3,000, $4,000, and $6,000. Keep in mind the cost of capital is 10%, and to estimate the net present value for Project S, we take the initial investment. Notice I put a negative sign there, it's a cash outflow, and I've simply taken the present value of the 4 cash flows at the 10% cost of capital, and I get $788.20. Using the financial calculator, which is how I got that number, you must start with Gold Clear All when you use the CSOJ keys. Put in the 10,000, make it negative by pressing the plus minus, and then press CSOJ, and then start entering the cash flows and press the CSOJ key. Once you finish doing that, to get NPV, you must enter the project cost of capital, so press 10 and then I per year, and then press Gold NPV, and you'll get the NPV of $788.20. Now, if we're wise here and knowing we're going to be asked to calculate the IRR, so I don't have to re-enter these cash flows, what you can then simply do is don't hit Gold Clear All. After you've hit Gold NPV, then press Gold IRR per year to get that answer. We'll point that out when we get to that calculation in a moment. For Project L, again, take the initial investment, cash outflow, it's negative. Take the present value of its net cash flows over the 4 years, and we get a net present value of $941.77. Using the calculator, we hit Gold Clear All, we enter the cash flows, we enter the cost of capital, hit I per year, and then press Gold NPV, and we get the 941.77. So we've estimated the net present value for both projects. Based on NPVs now, which project or projects should be accepted? Well, let's recall that S had a net present value of $788. L had an NPV of $942. If the projects are independent, you would accept both projects. They both have NPVs greater than 0. If the projects are mutually exclusive, you would just accept Project L because it has a higher NPV than Project S. To get the IRR for Project S, take the NPV equation, set it equal to 0, and instead of putting in the cost of capital, leave that as the unknown, which is the IRR for the project. Of course, that's going to be an iterative solution. If you hadn't already done the NPV, you would start over with Gold Clear All, enter the cash flows, and then just press Gold IRR per year. You don't have to enter the cost of capital to get the IRR per year. Now again, since we already had entered those cash flows and entered 10 I per year and Gold NPV, it would have been ideal at that point to do the Gold IRR per year. But if you hadn't, these are the steps you would need for IRR per year. You'll get 14.49%. And if you were to plug that in and do the math here, you'll get very, very, very close to 0. To get exactly 0, you'll need to get a lot more decimal places on that, but I don't want to fill your screen with decimal places. So that's the IRR, 14.5%. We'll round it up. For Project L, take the NPV equation for L set equal to 0, and you're going to solve for the unknown interest rate, the IRR. The HP 10B2 calculator will tell us that it's 13.54%. If you start with Gold Clear All, enter the cash flows, and again press Gold IRR per year. Plugging that in, you'll get close to 0, and we can conclude the IRR for Project L is 13.5%. Okay, based on the IRRs now, which project or project should be accepted? Let's recall that the IRR for Project S was 14.5%, and the IRR for Project L was 13.5%. Well, if the projects are independent, we should accept both projects. You would compare the IRR for each project to the project cost of capital, which was 10%. And Project S with an IRR of 14.5%, that's higher than 10%, and L with its IRR of 13.5% exceeds the cost of capital 10%. So they're both acceptable. And notice, let me point out that you can use, for independent projects, you can use NPV or IRR. You'll get the same decision. If these IRRs were less than, let's say it the other way, if the NPVs had been negative when we calculated the NPVs, these IRRs that we would have calculated here would have been less than 10%. We'll see that when we do an NPV profile in the next section. Okay? But for independent projects, NPV and IRR will be consistent in telling you whether to accept or reject a project. If the projects are mutually exclusive, using IRR would have led to selecting the wrong project. You would have said take S with the higher IRR. But we saw before, in the first part of this example, that project L had the higher net present value. So there's a conflict there, and we would rely on NPV because NPV tells us the value, the net present value of that project. And that's consistent. Choosing the project with the higher net present value is consistent with the goal of maximizing shareholder wealth. You're accepting the project which is expected to add the most value to the firm, and that's why we use NPV. Now, let's finish this section by looking at the NPV and IRR methods in relation to the desirable criteria that we spelled out in the first video. At the end of that first video, we highlighted some desirable criteria that methods for evaluating projects should have. The first one we said is that the project should incorporate net cash flows, not accounting measures such as net income. And both NPV and IRR use net cash flows. They should include all the estimated cash flows over the life of the project. And yes, there's no reason for using anything other than that. The NPV and IRR techniques allow you to use cash flows for 100 years if you had a project that long. Okay? So there's nothing inherent in the calculations that would require you to cut the project life short and only use the first X years, a subset of the total number of cash flows. Does it take into account time value of money? Absolutely. We were calculating the present value of all the future net cash flows. Do they incorporate risk? Both methods do, through the cost of capital. The higher the risk of a project, the higher the risk-adjusted project cost of capital. Now, that's actually taken into the computation of NPV because we discount those cash flows at the project cost of capital. For IRR, you actually don't use the cost of capital in the calculation itself. But then when you get the IRR, you compare it to the project cost of capital. So in the decision criteria, you are incorporating the risk of that project. Lastly, do these techniques help to identify projects that should lead to shareholder wealth maximization? NPV, yes, because I stated on the previous slide, the NPV method would lead to accepting the project if it's mutually exclusive that has the most value of the other alternatives. Or for an independent project, you're accepting any project with a positive net present value. So you're adding to shareholder value. You're maximizing shareholder value. But not with IRR. With the IRR technique, with mutually exclusive projects, as we saw in the example, the IRR technique may identify a project with a higher IRR that actually has a lower net present value. So the IRR has one flaw there we see compared to the NPV. So the NPV is the superior method over the IRR. Okay, this ends our second video in capital